So interest rates, the elephant in the room, right? So I'm going to give you a tool first off, just like a friendly tool of how to determine what's happening with interest rates. That's very, very, very user friendly. And so there is a website, cnbc.com. And if you go to that website, it will not try to sell you anything. It will just give you information. And if you go to that website and you look up the 10-year Treasury bonds, you will find a graph, kind of like a chart. And you can click on it like last 30 days, last 5 years, last day, whatever you want. And you will see pretty much the history of what's happening with rates up until right now, this very second. And so what's helpful about it is if it is 3 o'clock in the afternoon and I'm on the phone with your client and they are nervous about locking their rate, they're not sure if they want to lock their rate or not, most of the time at 3 o'clock in the afternoon, I'm going to look to see what the 10-year Treasury bond is doing to determine if that client should lock that rate today or if they should wait until tomorrow morning to lock their rate. So a trend would be if the 10-year is trending down all day today and it's 3 o'clock in the afternoon, the likelihood is that when the market opens tomorrow, interest rates are going to be slightly better. And so I would most likely tell that client to wait till the following day. Flip side, if the rates are getting bad or worse all day long and it's 3 o'clock in the afternoon, I'm going to advise your client to lock as soon as possible because most likely when the market opens the following day, interest rates are going to be higher. And so it's a really good tool to use when clients are like, well, rates 2 years ago were 2%, and why are rates where they are right now? It's a very user-friendly graph that you can pull up and use and show your customer what's going on with interest rates because for all of time, which my experience, my anniversary is coming up of 30 years this November, so forever, you will find that the 10-year Treasury is parallel with interest rates. And so the way that that moves is the way that interest rates move. So it's a really good website for you guys to just have on your phone and inform clients. And so interest rate options. There are 3 buy-down options that your client can utilize. There is a permanent interest rate buy-down, there is a temporary interest rate buy-down, and there is a float-down option. Now, not all lenders offer all of these products. For example, my branches or my division offers a float-down option for free to your clients. And so that is a substantial cost to us to maintain that loan if that occurs. So I'll give you an example. Let's say your client is locked at 6.75%, and we're a week from closing. We've had the loan for 30 days, and now interest rates go down. Your client calls us up and says, I'm going to go with a different bank because rates are lower, and why wouldn't I go get the best interest rate? I still have a week to go. So now I want to extend my closing because I want to go with a new bank. Well, why would any lender want to lose business with that regard? They obviously wouldn't, right? And so you will be surprised that many do not have a float down option, which is interesting to me. We have one. And basically what we would say is, client, the minute you lock your rate, you are going to be alerted automatically in your email if the rates have improved by 0.25% or more, and all you have to do is click it, and we will offer you the float down option for free. Now, it is going to ask you when you click it for a 1% charge of your loan amount. So to utilize the float down option, there is a 1% fee associated with it. So it'll say, hey, Carlos, you want to buy your rate down to, whatever, 6.25% or whatever it is. But you have to pay 1% of that. So on a $240,000 loan, that's $2,400. Your client might say, well, I'm just going to stay where I'm at. I don't want to pay $2,400 for the lower rate. I'd rather just either A, switch my lender and go somewhere else, or B, I'll just stay where I'm at. Well, why would we want to do that and jeopardize losing the client? So we will offer them a float down option for free, and when we're locking the rate, that's something we go over with them, and they love it. They're super grateful for that, and we've utilized it a lot of times in this market, and it's something that we offer that clients really seem to appreciate. So that's pretty much how a float down works. A permanent interest rate buy down works like this, and there is a big misconception on this one. And so client says, I want to pay a point to buy my rate down. Their interest rate, let's say hypothetically, is 6.25%. They, most of the time, assume that by paying that 1% fee, that their interest rate is going to be 5.25. A lot of clients actually think that, but that's actually not how it works. The interest rate buy down permanently works in pricing increments. And so depending on the day, depending on their loan, depending on their type of loan, depending on their credit, state, property type, etc., is how that is going to be affected. So for example, that client might pay 1% and only go from 6.25 to 5.99, but it did cost them 1% in that scenario. And so point being is that a temporary buy down is not a fee per interest rate evenly. It depends on the market and that day how much that buy down is going to be. So I will tell you though that when we are going over your rate lock with your client, we are giving them options. And so we do this a lot, honestly, right now. We'll pretty much say, hey, you can have 6.25 at no cost. You can have 5.99, it's going to cost you $2,400, or you can have 5.75, it's going to cost you $4,000. Let's go over which option works the best, right? And so a good consultation call regarding rate should take about an hour. So in this market, it's a lengthy conversation. So that's kind of how long-term interest rate buy downs work. But the advantage is once they buy the rate down, that's their rate forever. They don't have to worry about it. That's their rate forever. It's pretty simple and straightforward. Temporary buy downs is where it gets tricky. This is kind of like a thing from the past. It was big back in the 90s and late 90s. It kind of went away, and now it's something that we're seeing frequently, and that is a temporary buy down. The way that works is this. There are options. So I feel like there are many options on everything that I'm going over, right? But there are options. You can do a 3-2-1. You can do a straight 3-2-1. You can do a 2-2. You can do a 1-1. You can do a 2-1. I'm going to explain to you what that means. So this is how it works. Let's say that your customer's starting rate, to make it easy, is 6.25. Okay? Let's say they want to do a 1-1. They want to buy it down 1% for 1 year. That means that's a 1-1. That would mean that their interest rate would be 5.25 for 1 year. So how do we determine how much that's going to cost? Well, we take whatever their savings is in their specific monthly payment. So let's assume that their savings is $200 a month. And we're going to take $200 a month times 12 months, which is $2,400, and we're going to put it into an escrow account for them. And every month they make their payment, that $200 that they fronted at closing for their temporary buy down is being pulled from their escrow account and applied to their mortgage payment on their behalf. So it is a dollar for dollar buy down. So they're like fronting money to lower their mortgage payment for a period of time. But let's say, just to kind of break it down for you, the customer paid $2,400 to save $200 a month. However, now they've only had the loan for 6 months. So they didn't get to take advantage of the savings or the cost that they put out for the whole 12 months, right? Because they're like, what happens to the rest of that money in my escrow account? What happens is when they refinance or sell the house or pay the loan off in any manner, that money from that escrow account is simply getting applied to the principal of the loan. So you would think, why would a customer front $200 a month for a whole year ahead of time just to have a lower monthly mortgage payment? Why does that make sense? Why would anybody do that? Why would they not just take the money, put it into their personal savings account or interest, bearing money market account, which right now is giving about 4.875% in some money markets, right? And make interest on their money versus giving it to a lender to put in their escrow account so that lender can make interest on your money. Because that's what's happening behind the scenes, by the way, right? And the answer to you is because the seller can pay for it for them. So they can say, I want a $10,000 seller assist, and out of that $10,000 seller assist that I'm going to pay over 30 years, which maybe I'm only going to have the house for 10 years or 5 years, so I'm never really going to pay that money long term, technically, right? So they can take the seller assist, that $10,000, and they can buy that interest rate down all the way to 3.25. So they can have 3.25 for the first year, 4.25 for the second year, 5.25 for the third year. they don't get to 6.25 till after the third year. And in this market, let's be real, they're never going to see the end of that third year because they're going to most likely refinance out of that loan. So it's utilizing equity in the property that they don't have yet to put towards a principal reduction of the property balance later. And the way that property values are going to increase and your property balance is going to go down, there is a long-term benefit to doing that. Does that make sense? You guys understand that? So it's kind of, I hate to say it because I know I'm on camera, but it's kind of, I call it a trick. Because if I have a smart client, my advice is going to be, take the money. If you're going to use your own money to do this, I do not recommend doing it. I would just put it in your own bank account and pay your own mortgage like a big grown-up girl, boy, right? And if you're getting it from the seller, then get it from the seller and do the temporary buy down to utilize all the seller assists, especially if you can get 6% and your closing costs don't equal 6%. It's a good way you could take that additional closing cost assistance and apply it to your principal later, which is ultimately going to benefit you when you sell or refinance. And that's how interest rate buy downs work.